Okay, so this is to pick up where I left off on the last video. So here I've mapped out the E entry. Then here's the A entry, and what you want to be careful again with the A entry is that it's the beginning of the year. So you need to adjust each one of those acquisition accounting premium assets for 3 years of depreciation, 3 years of amortization, 3 years of amortization to come up with your total. Then if we come over to here, we're eliminating our equity income, which we had already mapped out. Eliminate the dividends to our subtotal of that $53,586. Then this is the new one for this chapter. We have a beginning of the year inventory adjustment. So $12,597 is the profit that we deferred at the end of 2012. But we are now letting come through because we sold it out in 2013. So it's hung up in our equity investment based on the parents' entries using the equity method of accounting. So then now we need to adjust it, but remember it's a negative. So then you take the time to add up your E entry, your A entry, your C entry, and then your I entry, and then you have a subtotal then that should equal the equity investment on the parents' books, and it does. Okay, then over on this side I've started to map out the new I entries. So this first one, we eliminate the intercompany sales for the current year. So to do that, we debit sales for the full amount of the $68,000, credit cost of goods sold for $68,000, and then that eliminates the sale completely. Then down here it says, okay, but all of that wasn't actually sold out. So we've got to adjust this entry a little bit. So we debit our cost of goods sold for the gross profit that's left in our ending inventory at the end of 2013, which is the $19,380. And then we reduce the inventory value because right now inventory is overstated. So that's also a credit of $19,380 to reduce inventory back down to cost. Then we have a beginning of our beginning of the year entry. So what we adjusted our equity investment for over here, we have to debit the equity investment for $12,597, and then let that profit run through. And we let it run through by crediting our cost of goods sold. Right now our cost of goods sold are overstated by that profit. So now we have to reduce it. Then we have one final entry to make, and that deals with our payables and our receivables. So it tells us that there's a $27,200 receivable at the end of the year. So then we need to debit the accounts payable for $27,200 and then credit the accounts receivable for $27,200. And then that completes our entries. So then you still have your E, your A, your C, and then your D for the depreciation. And then now you have these I entries, and you'll have you'll have 4 I entries when we're dealing with these intercompany inventory